There's a tax window closing at midnight on December 31st, 2025, and most people with pre-tax retirement savings have no idea it exists. Here's the situation. The Tax Cuts and Jobs Act of 2017 cut income tax rates across almost every bracket, but Congress built in an expiration date. After 2025, those rates revert automatically unless Congress acts. According to the Tax Policy Center, a married couple filing jointly earning $100,000 could see their effective federal rate climb by several percentage points overnight. If you have a 401k or a traditional IRA, money you've never paid taxes on, this is the moment you've been waiting for. Lower rates right now mean you pay less to move that money into a Roth, where it grows tax-free forever. What you need to understand is how this window works, who it helps most, and what the math looks like for a late starter who still has time to act. What a Roth conversion actually does. Let's make sure we're starting from the same place. A traditional IRA or 401k is pre-tax money. You got a deduction when you put it in. The IRS has never touched it. When you take it out in retirement, every dollar is taxable as ordinary income. A Roth account is the opposite. You pay tax going in. After that, growth is tax-free. Qualified withdrawals in retirement are tax-free. And crucially, Roth accounts are not subject to required minimum distributions during your lifetime. A Roth conversion is the act of moving money from the pre-tax bucket into the Roth bucket. You pay income tax on whatever amount you convert in the year you do it. That's the cost. The benefit is that every dollar inside the Roth from that point forward, including decades of growth, will never be taxed again. For someone in their late 40s or 50s with 15 or 20 years before full retirement, the math on that trade can be extremely favorable. Your individual situation, your current income, your projected retirement income, your state tax rate will shape the specific numbers, but the directional logic is consistent. Pay tax at today's lower rate. Avoid tax at tomorrow's potentially higher rate. How the Tax Cuts and Jobs Act created this opening. In 2017, the Tax Cuts and Jobs Act reduced rates across nearly every federal income tax bracket. Those reductions are real and they're still in effect right now through the end of 2025. Here's what the current brackets look like for 2025 for married filing jointly, according to the IRS. The 10% bracket covers income up to $23,850. The 12% bracket covers up to $96,950. The 22% bracket covers up to $206,700. The 24% bracket covers up to $394,600. Under prior law, which is what returns to the books on January 1st, 2026, if nothing changes, those same income levels would be taxed at higher rates. The 28% bracket, for example, comes back. Brackets compress. The 15% bracket, which was effectively replaced by 12%, disappears. The Tax Foundation estimates the top effective rates on ordinary income would rise by 2 to 4 percentage points for many middle-income households. Here's what I want you to notice. The 22% and 24% brackets are historically low. Prior to TCJA, income in that range was taxed at 25% and 28%. That gap is the conversion window. Every dollar you convert in that band right now costs you 22 or 24 cents on the dollar. After 2025, under pre-TCJA law, those same dollars could cost you 25 to 28 cents. My take is this: if your income and your IRA balance put you anywhere near those brackets, the arbitrage is real. The critical variable is whether Congress extends the cuts. They may, but legislation is not guaranteed. The right move is to plan for the sunset and treat any extension as a bonus, not the other way around. Running the numbers. Bracket math for late starters. Let me walk through a simplified example so this feels concrete. Say you're 54 years old. You have $280,000 in a traditional IRA. Your household income from work is $85,000. You file jointly. In 2025, your taxable income after the standard deduction which the IRS has set at $30,000 for married couples filing jointly in 2025, puts you at roughly $55,000 of taxable income. That sits you solidly in the 12% bracket with room to spare before you hit the 22% threshold at $96,950. That gap from your current taxable income up to the top of the 22% bracket is conversion space. In this example, you could potentially convert around $41,000 and pay no more than 22 cents on the dollar for any dollar converted above the 12% ceiling. Now run the same scenario post-2025 if rates revert. The 15% bracket and the 25% bracket return. The standard deduction shrinks. Your effective cost on those same converted dollars rises. That same $41,000 conversion costs you more. You get less Roth for the same tax pain. Your filing status changes this math significantly. So does any pension income, Social Security income you're already collecting, or rental income. The example is illustrative. The principle is directional and it is clear. What required minimum distributions have to do with this? Here's where the urgency sharpens for late starters specifically. Under the Secure 2.0 Act, passed in December 2022, the age at which you must start taking required minimum distributions from pre-tax accounts rose. If you were born in 1951 or later, your RMD starting age is 73. If you were born in 1960 or later, it's 75, according to the IRS. That sounds like good news. More time before the government forces withdrawals. But here's the other side of it. The longer your pre-tax balance sits and grows without any conversion, the larger those forced distributions become when they hit. The IRS calculates your RMD by dividing your account balance by a life expectancy factor from their uniform lifetime table. A $500,000 IRA at age 73 generates an RMD of roughly $18,900 in the first year. A $1 million IRA generates roughly $37,700. Those withdrawals are fully taxable income. They can push you into higher brackets. They can trigger IRMAA surcharges on your Medicare premiums. And that's a whole separate video. I spend my days digging into the rules retirees actually have to live with. And the RMD trap is one of the most predictable and most avoidable problems I see. Converting a portion of your pre-tax balance now, while rates are low, reduces the future balance subject to RMDs. That shrinks your future forced income. It may keep you in lower brackets in your 70s and 80s. The math on that compounding benefit is substantial, depending on your balance and life expectancy. How to think about sizing a conversion. The most common mistake people make when they learn about this is going too big, too fast. Here's what I do. Identify your bracket ceiling for this year. Calculate how much room you have between your current taxable income and the top of the 22% or 24% bracket. That is your conversion budget for the year. Convert up to that ceiling. Stop there. Why stop there? Because the 32% bracket kicks in above $206,700 for joint filers in 2025 per the IRS. Converting past your bracket ceiling accelerates your tax bill without proportionate benefit. The goal is to fill each bracket efficiently over multiple years, not to convert everything in one shot. For late starters, this means 2023, 2024, and 2025 are each a year to be strategic. If you've already converted in prior years, good. If you haven't started yet, 2025 is the last confirmed window under current law. There is no guaranteed extension. The amount that makes sense to convert depends on your current income, your projected retirement income, your state taxes, and how much of your savings is in pre-tax accounts. Someone with $50,000 in a traditional IRA has a different calculation than someone with $600,000, but the direction is the same for both. Pay today's rate on as much as fits in the lower brackets. Protect that money from future taxation. One more thing worth flagging. If you're converting, pay the taxes from a taxable account, not from the converted funds themselves. Using IRA money to pay the tax bill reduces the amount that lands in the Roth and can trigger a 10% early withdrawal penalty if you're under 59 and a half, according to IRS rules. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. The window is real. The expiration date is set. Whether Congress extends the Tax Cuts and Jobs Act or lets it sunset, the right move is to understand this opportunity now, before December 31st, 2025, and make a decision based on your own numbers. If this video helped you think more clearly about Roth conversions, subscribe to the channel. There's a lot more coming on, exactly this kind of retirement tax planning for people who are serious about catching up. What topic would you like me to dig into next? Drop it in the comments. I read every one, and I pull directly from those questions when I'm planning upcoming videos. And next week, we're covering something that catches a lot of retirees completely off guard: the Medicare surcharge that kicks in when your income crosses $103,000. If you're converting a Roth or drawing down pre-tax accounts, your income level directly affects what you pay for Medicare, and the numbers are bigger than most people expect. This video may contain affiliate links. I only recommend tools I use personally.